So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, can my covered call get assigned early? So the simple answer to this is yes, it can get assigned early. So I want to walk through the possible scenarios in which case you might be assigned early on your covered call option, which would then take away the stock that's basically covering that call option. Now, there's probably a couple scenarios, but the most likely scenarios that would happen include short dividend assignment. So what we talk about with short dividend assignment is that if a stock is going to pay a dividend, and if the stock has been rallying much higher or dramatically higher and is about to pay that dividend, that might be an instance where your short call option gets assigned early on your covered call position. And the reason would be if the dividend payment is actually more than a corresponding put option to your short call option. And in those scenarios, as we've discussed in other examples on the website, what would happen is that the short or the long option buyer would exercise their contracts, collect the dividend, and then use that dividend payment to then immediately buy put option protection, which basically gets them back into the same synthetic long call option position that they had originally. So again, one of the instances where you could be assigned on your covered call is if your call option is in the money and the corresponding put option to your call option is worth less than the dividend being paid. Now, another instance where you could be assigned early on covered calls is just generally when the call option starts approaching expiration and it's in the money. Now, what you'll want to watch out for is the extrinsic value that's left in the covered call. So if you have an option contract that's in the money, but you're far out from expiration, there's probably a very little chance, almost no chance that that call option's assigned. And it's because the contract that you have still has a lot of extrinsic or time and volatility value baked in. So as you approach expiration, most of that time value or that volatility value starts to decay away, and the option starts trading more in line with the underlying stock. And so for that reason, as we get closer to expiration, if you notice that the extrinsic value of your option contract starts to whittle away and is down, say, under 5 cents or so, you're probably more at risk of assignment. So again, it doesn't mean that initially, if your call option goes in the money, you'll be assigned automatically. It's more likely to be assigned closer to expiration if the option is still in the money. So hopefully this helps out. As always, if you guys have any questions, please let us know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.